Folks, welcome back to the Microstructure Exchange. We hope that you've had a great break from us, but we've got some interesting papers to be presented over the next couple of months. I just have a couple of announcements before introducing Dmitry. Congratulations to the winners of the Words Microstructure Exchange Prize for the best paper. The winners are, as our email mentioned, James Bergler and Taylor Hendershot. Thank you all for voting for the best paper, and thank you also very much for selecting the papers to be on the program this fall. One more announcement. As some of you may remember, we had a bit of a security incident last spring when a person logged in and kind of disrupted our flow. So we have a bit of a tighter security this season. We've disabled everything that we could disable, and we've muted everyone. So the only way to get unmuted now is to raise your hand when you'd like to ask a question, and then we will manually unmute you. And we hope that this will prevent further incidents. This is it from us. We're very excited to have Dmitry Muravyev here today with a paper about retail options trading. Dmitry is happy to take your questions as they come, so just raise your hand and we will unmute you. He does have to go teach in an hour, so when that happens, Vincent, his co-author, is going to take over with the remaining questions. Dmitry, thanks for your time, and please take it away.
All right. Thank you, everyone, for coming, and it's an honor to start this season of the Microstructure Exchange. I was actually lucky to present at one of the first Microstructure Exchanges in May 2020. This was like 4 years ago, so it's really great to see that the seminar continues to continue to thrive. So I want to share with you my latest work with Vincent Bogousslavsky, who is also here and will help me with the questions. And what we're trying to do here is we're trying to understand how retail investors trade in the options and in the stock market. And the key ingredient here, we will be bringing in account level data for the recent period, multi-broker data set from the US investors. And I thought that I knew everything about the options market. I knew what to expect. I thought that we will just use this account level data to sort of like quantify some of the points that the prior literature made, but I actually was like wrong half of the time, or even on the stylized facts. So I'll be curious to know what you think and what you find the most surprising. I certainly was surprised by the results. And before I move on, to set the expectations a little bit, this is not a conventional microstructure paper. So we will have one slide with like the bid-ask spread and this kind of stuff. But I think it's microstructure in a way that we are trying to understand how a group of investors in this market, in this case, retail option investors, what do they do, how do they do it, what the outcomes are, right? So before I move on and explain, summarize the results, I think it's important to motivate this question because it's not obvious that looking at retail option trading is important. It was not important, certainly was not important 15 years ago when I was on the market. So let me try to convince you that retail trading in the options is a pretty substantial one, at least economically. And I will use 3 data points here. So the first data point, this is a nice chart from The Economist, which just shows a general growth in overall aggregate option volume. This is for S&P 500, but it's very similar for the aggregate market. And what we can see here is really the spike in option trading volume around COVID, and then post-COVID option volume continued to increase. And this increase was driven a lot by shorter maturity options. We don't know which group of investors contributed the most to this growth, but there is this implicit understanding that retail investors did contribute a lot to this growing option volume. Anecdotally, I see that I teach derivatives, so my students became much more interested in learning about what calls and puts are after COVID because many of them trade those. So that's observation number 1, option volume was on the rise. Observation number 2, so if we look at any broker out there and look how those brokers make money, and specifically look at their trading-based revenues, there are 3 major asset classes that retail investors trade. So stocks, crypto, and options. So this is the latest quarterly report from Robinhood, and what you can see is options are non-negligible. In fact, options contribute $182 million versus only $40 million for equities. So from the broker's perspective, options is a really important source of revenues. So that's observation number 2. And finally, observation number 3, there are ways to more directly compare option trading activity with stock trading activity. Here's just one particular way of doing this. This is based on our data set. So what you see here, the blue line shows you each month the fraction of investors in our data set who trade at least some options. And we see that by the end of our sample period in 2020, it was kind of broadly approaching half. So approximately half of our investors in our data set were trading at least some options by the end of the sample period. The green line looks at the percentage of all trades in our data set each month, what fraction of them are option trades. And again, we see that close to the half of all trades in our data set by the end of the sample period were option trades. And finally, the orange line, which was kind of surprising to me, we'll look at percentage of traders who trade only options and don't trade stock. And we see that the orange line suggests that the number of investors who trade only options is non-negligible, which was surprising to me. Like, in retrospect, it's not surprising. Why we're surprised that stock investors trade stocks, futures invest. If retail investors trade futures, they probably trade a lot of futures. But there are some investors who are able to satisfy their trading need by just trading the options market. So if I have to summarize those 3 slides, it seems like if we look at retail trading 20 years ago, if we look at the Barber and Odin data set, there are retail option trades there, but there are just so few of them there. So 20 years ago, options wasn't a thing for retail traders, but right now it's a substantial chunk of overall retail trading. I wouldn't say it's really exceeds the stock trading, but it kind of like approaching the stock trading, and kind of in some dimensions it rivals the retail stock trading. So I would say that retail option trading is economically non-negligible, and we probably should study it. Of course, academics are not the only people who notice those trends, right? Everyone kind of noticed them. Regular and social media, of course, raises the concerns of what's going on, right? If we see so much retail option trading, what's the motivation behind those trades? What are the ultimate outcomes? Do those people, I don't know, use options for reckless speculation and lose a ton of money, right? So what we're trying to do in this paper is provide some evidence along those lines to answer some of those questions. And the key ingredient here will be, to our knowledge, where the first will bring account level data on a joint trading in the stocks and options in the US in the recent period, right? I'll describe this data in a couple of minutes and, of course, more detail. But you can think about those as 5,000 retail investors. We know that for sure they're retail. And the way you can think about them as TD Ameritrade investors who are somewhat more active than average and somewhat more sophisticated than average. This being said, is with retail trading, everyone who worked with account level data knows that there is just huge heterogeneity, and we will exploit this heterogeneity. So in particular, with this data set, we will look at different subsets of investors, where investors who are more sophisticated here, investors who are less sophisticated, investors who only trade options, investors who only trade stocks. So we'll look at each of those groups to see how sensitive our results are. So we'll have this account level data set, which I'll describe in a minute. And what we do is 3 things. So we'll document a couple of stylized facts. We will look at the profitability. Do those retail investors lose money on average? And then we'll try to understand their trading motives, although it's a little bit difficult because we only see the outcomes of their trading. We cannot get in their head. So what are the stylized facts? Number 1, I already showed you that there are quite a few retail investors who only trade options and don't trade stocks or anything else. So for those investors, it's enough to satisfy their trading needs. Stylized fact number 2 is that retail trading in stock market is fairly concentrated, but retail trading in the option market is 10 times more concentrated. Basically, top 10 underlines in the option market account for like more than half of all trades, which has implications for how we do research, right? So if we want to do the analysis of an average optionable stock on an average day, that could present a skewed picture because an average optionable stock, and we're at approximately 2,000 optionable stocks in there, see very little option volume and very little retail volume. So retail option trading is really concentrated in just 10 tickers. And if we look at an average retail trade, unsurprisingly, the trades start with a purchase. So retail investors will first buy a call, buy a put, and then they will close position with a sale. So that's not surprising because naked selling of options, some brokers just don't allow naked selling of options. And then what was more surprising is the type of underlying they will typically use. So S&P 500 index options are typically thought as primarily institutional trading, but S&P 500 will be the most popular underlying for retail trades in our data set. Retail investors will trade relatively short-term options, so maybe like 1 or 2 days to expiration, and they typically will close the position the same day. So again, let's just start by establishing some basic facts about what retail investors do. Once we do these facts, we can look at what are the outcomes. So for every trade, we see how much money they make and how much money they lose in like absolute and percentage terms. So the current literature, which I will describe in a minute, kind of has this negative take on retail trading in general, and especially negative take on retail trading in the options market. So the implicit message is that retail investors lose a lot of money in the options market. We actually find that losses are relatively small. So the losses, pure trade losses in percentage terms are less than 1% per trade. And this less than 1% per trade on average loss is only slightly higher than total commissions in the options market and much smaller than the bid-ask spreads in the option market. So number 3, retail investors don't seem to lose that much money. There is, of course, very huge heterogeneity here in profitability, and some subset of trades deviate from the average. One subset, which was particularly interesting, is naked sales of options. So if investors sell a call or sell a put without having a prior option position, so those trades of naked option selling, they do make a lot of money. We have some ideas for why this is happening, but we don't have a very good understanding. And then finally, number 4, we're trying to understand what those people are trying to do, why they're trading options. And to me, it was like a no-brainer. Of course, we know why everyone trades options. It's high embedded leverage. And because retail investors will primarily buy option calls and puts, it's probably will be positive skewness if they hold an option until expiration. So I was very surprised to find that, yes, there is some embedded leverage, right? So if you invest $100 in the options versus investing $100 in the stock, the P&L on your option trade will be more extreme than the P&L on the same amount invested in the stock trade. But empirically, because retail investors, they size their option trades about like 4 to 5 times smaller. So the aggregate, the net leverage effect is it's statistically significant, but as I will show you, it's not economically large. So embedded leverage, statistically, yes, economically, kind of not as much as we expect. The biggest surprise was on the skewness. So if retail investors buy calls and puts and hold them until expiration, which they almost never do, they're guaranteed to get positive skewness. Their losses are limited to the price they paid. Their gains are potentially unlimited. But if we look at the distribution of retail P&L in dollar terms and see whether it's a right skewed or a left skewed, we find that empirically it's fairly symmetric. So we didn't find much evidence of pureness, positive skewness or in realized P&L for retail trades. So maybe retail investors want to get positive skewness by buying calls and puts, but empirically that's not what they get. And we think part of the reason why they don't achieve positive skewness is very short investment horizon. The last point is there are all of those complex option strategies which teach in the investments and derivatives class. I teach a lot about like covered calls, protective puts, how you can do all of those nice things by combining options and the underlying. Turns out empirically, at least investors in our data sets really prefer simple strategies. They very rarely combine options with the underlying. So Mostly the answer was no to all of the standard reasons for trading options, which we were studying like every undergrad derivatives class. Then why do retail investors trade options? So one of the striking facts which we find is the striking difference between the underlying price for option trades and the stock price for stock trades. So the typical stock price will be $10 to $20 for stock trades, but the typical underlying price for option trades will be like around like 20 times that amount, around 200, even after we exclude all of those S&P trades. So it seems to be that the retail investors trade options to get an affordable way to participate in stocks like Nvidia or some high price ETFs. That will be difficult for them to trade otherwise. So that's the result summary. So this is a descriptive paper which provides a kind of a broad set of stylized facts and start the debate about what retail investors really do in the options market. How does this contribute to the literature? So we already know a lot about how retail investors trade in the stock market, especially thanks to Terry O'Dean, who shared his account level data set. So again, option trades are in his data set. The problem is there are very few option retail trades in early to mid 90s. This has changed. So right now, options is a major part of retail trading. And this is why there is a recent literature which reemerged and really looked at how the new generation of retail investors trade and how they trade in the option market. There are a couple of papers here which are important. So Brizgalova, Pavlova, and Sikorska is an important paper because we know how to measure retail trading in the stock market using BGZZ or some adjusted method. So they introduced something similar for the option market. So we can look in the OPRA data and see trading flags in the OPRA data, and some of those trades presumably correlate with retail trading, right? Overall, this literature using this kind of method paints a somewhat negative picture of retail option investors. So they seem to in a sense that everything we know negative about retail in the trading in the stock market, the literature in the option market kind of portrays just essentially option retail trading is just much worse, right? So if we think that retail stock investors are unsophisticated, then option investors are much more unsophisticated. If you think retail investors lose money in the stock market, they lose much more in the options market, right? Uh, uh, so there is some international evidence with account level data, but we will be the first ones to look at the US. There is an emerging literature on option market microstructure. Of course, there was a lot of great work done in 90s and 2000s by people like Stu Mayhew, Rob Battaglia, and Amber Anand, but there is this list wave of papers. I think Tom and Chester presented their paper. He's at Microstructure Exchange. So Terry presented his paper here. And if you're interested in this line of work, Amber Anand will present in kind of a similar paper later on in November, where he looks at the internalization in the options market and how it affects quote competitions and ultimately the option bid-ask spread, right? Right. So overall, if we think of the retail side of this option literature, again, it pictures a somewhat negative narrative for retail trading in the option market. So those people kind of, right, for the lack of the better word, are reckless gamblers and they lose a ton of money. So our results are somewhat less extreme. We find that retail option investors, they don't lose nearly as much money. Maybe they gamble, but they just don't get the positive realized skewness. Whereas some embedded leverage, but they do size trades much smaller. So essentially, our main message is the retail option investors don't seem to be like that much of the extreme kind of species. So the key ingredient of what we do is the data. So let me describe the data and then take some questions. So we observe 5,000 retail investors, their trade histories. This is a multi-broker data set. We have 5 to 6 brokers out there, and it covers the period from 2020 to 2010. Right. So what would be an ideal data to study retail trading? Well, if we, like in some of those Scandinavian countries, if we observe every single investor and we observe all of their portfolios in the US, that would be ideal. Right. The second idea, kind of best thing, would be to get a broker like TD Ameritrade to share the data. But well, most brokers by now learn that you need to be really cautious sharing data with academics. So this particular data set will come from a trading journal. So what is a trading journal? I kind of knew what a trading journal was, but I'm not sure any of you did. So what is a trading journal? So you go to the website, you create an account like you would do in any other website. You will provide the credential for your retail brokerage account. Maybe you have an account with the TD Ameritrade, and then the trading journal will automatically load and verify the trades that you did with your broker. And why you may want to use the trading journal, it will verify your performance. So it will verify that your broker says is correct, and it will provide presumably better analytics tools, better graphics tool, alternative graphics tools, right? So we will be using one of those trading journals, not the major one. So one of those non-major trading journals, by default, made all of the trading profiles public, and I don't think that many users realize this. So vast majority of users didn't change the default. So what we did is essentially those profiles were public, and we just scraped them. So what kind of information did we get? So what we see is the information at the parent trade level or the round trip level, something that if you open your broker, like your broker page, say at the TD or Interactive Brokers, you will see, hey, I bought the Tesla, then I sold the Tesla on this day, I made $100 on this trade. So this will be the parent trade. So we will observe a 1.5 million of parent trades in the stock, which are worth approximately $13 billion, $13 billion in and $13 billion out. And then we will observe close to 900,000 parent option trades with the cumulative premiums worth of under $2 billion. So 5,000 investors who do trade a decent amount. So what we observe is for each parent trade, we observe the symbol, we observe whether the original trade was a buy or a sell. We will observe the performance in terms of the return and the dollar gain. We will see the entry and exit date, and we will see broker ID. So in aggregate, we have 6 brokers here. TD Ameritrade will be the most popular one. We don't have Robinhood in this data set, unfortunately, because, well, Robinhood doesn't make it convenient to share the trading history with trading journals, but we will have a couple of brokers which are kind of like Robinhood-like, the new generation of those brokers. So unfortunately, at the parent trade level, we don't observe the exact intraday timing. So we will, for half of those accounts, we will scrape, in addition to scraping the parent trades, we were able to scrape the child trades. And for child trades, we have the detailed information, sort of the information you see in tech or Opera. So what is a child trade? So a parent trade, you will buy Tesla and then you sell Tesla. So maybe you buy Tesla with the one trade, you will buy 300 shares of Tesla, and then maybe you sell 100 shares, then another 100, and then another 100. So overall, this will be one parent Tesla trade, but those will be four child trades. And we see the continuous history of their trades through the tenure with the trading journals. We see some trading in futures, cryptos, and foreign stocks, but those are very, very negligible. You don't open an account with TD Ameritrade during this period to trade crypto. You will go to other sources. So primarily what we see will be US equities and US options. There are a couple of things which could be potentially worrisome about, like I had like lots of, like we scraped the data and then like, is it a good data or not? So the first thing that I was worried about that all of this is just play money. So sort of like maybe they have like $100 in their account and they, I don't know, they just gamble. You don't care. But the average trade size in our data will be several $1,000s. So those are non-negligible trade sizes. Another worry that I had is whether those trades are real or not. But with the trading journals, they import those trades, they verify the trades, and each trade has this verify thing, and the users cannot selectively delete trades or selectively report trades. So we do see the verified trades. Another worry would be that the sign-up date is endogenous to past performance. Likely, we observe trades both before and after the sign-up trade date, and we can we can control for this. And the last concern I had, who are those people who use trading journals, right? So are there some just weird people? For most of those traders, we don't observe any demographic details apart from the self-reported ID and self-reported location. But for some, they kind of put like the social media link or something like this, so we can kind of learn a little bit about them. And it's just surprisingly heterogeneous. So we had a pharmacist in Houston who trades options. We have a close to retirement software engineer in Omaha who trades a lot of stocks. We have some young folks who are trying to make it through and kind of like earn their living through trading. All sorts of people sign up for trading journals, and we will exploit this heterogeneity. So I think on average, I think about investors in our data set as TD Ameritrade investors who are somewhat more active than average, somewhat more sophisticated than average because they're really passionate about trading and they sign up for this trading journal. But we will see a lot of heterogeneity and we will look at different trader subsamples. So now that you kind of learn the basic message of the paper and you learn the basic facts about the data, I think it's a nice time to maybe take some questions if there are any.
Folks, if you are just joining us, to be unmuted, you should raise your hand. Well, just like Chester just did. And we are going to... Chester, you should be good now.
Oh, okay, thank you. So I was just wondering, to what extent should we be concerned, or are you concerned about selection bias and whether these active retail folks sign up to be in this trade journal? Maybe you can speak a little bit more about the nature of what it means to be participating in the trade journal.
And the selection bias, what exactly your concern is in terms of the selection bias? What selection bias you exactly have in mind? So
Chester,
just again,
you're muted.
but yeah, if not, I can start.
Yeah, because the host muted me. Oh, I'm sorry. Okay, sorry. By selection bias, I mean, what is the nature of participation in this trade journal as opposed to the vast majority of retail investors? How should we interpret participation in the trade journal?
Yeah, I think it's like one of the key and one of the most important questions. And the reason I asked this clarifying question, I wanted to make sure the selection bias, you mean like the general ability of those results. How much can we extrapolate those results beyond this data set? And I think it raises a more fundamental question about who we think is the representative retail investor, right? And it's a surprisingly deep question, right? For example, on the institutional side, we have a separate literature which studies mutual funds, hedge funds, other types of institutional investors. We kind of don't typically lump them together, right? We study them somewhat separately. So in the retail data space, right, until now, we kind of like different people have a very different idea what a representative retail investor is. For example, some folks will say, hey, buy and hold investors are the representative investors. Others will disagree and say, hey, no, the new breed of Robinhood investors will be representative. If you look at pretty much any retail paper out there, concerns about the general ability, right? Because, for example, if we only look at, say, I don't know, like those flags in Opera, those are only market orders, and who are the people who are submitting market orders? So I think there is an important question about like who the representative investors are. There are, of course, concerns that whoever you think the representative investors are, and most people disagree who they are, those traders' journal will be somewhat different. And again, I emphasize those differences. So I think like we have 6 brokers, and we will explore the variation across brokers. But this is TD Ameritrade. We don't have many of the Robinhood folks here. The people who sign up for trading journals, they are not buy and hold investors, that's for sure. So they do trade a lot. Otherwise, they're really passionate about trading. And because they're passionate about trading, they're probably a little bit more sophisticated. So the way we think about this, we will first acknowledge the average differences, as I just did. And the second approach is Because we do have account level data set, we can explore the heterogeneity in this account level data set. So there are some unsophisticated people in our data set. There are people who trade infrequently in our data set and hold positions for longer. So we will explore the sensitivity of how much our results change in all of those subsamples. And what we find is quantitatively the numbers do change, right? So unsophisticated people will lose more, but qualitatively the results will go through. So in short, our approach is to acknowledge to describe the average investor in our data set the best we can, and then to do the subsample analysis. Sunil?
Yeah, you may have already thought of this, but it may be worth your while to make some simplifying assumptions about marginal tax rates and look at after-tax profits. You know the entry point, you know the exit point. So it might be worth doing.
It's an interesting idea. So the returns we observe, the net of commissions and net of the bid-ask spread, so they're pre-taxes. So the numbers I will show you will not account for any of the tax applications. They will also not account for any of the margin costs. So if there are no,
yeah, go ahead.
If there are no, yeah, if there are no other questions, then I'll move on. All right, so I summarize our results. I talk about the data. I talked about the limitations of this data, right? Ideally, I'd like to have every single retail investor. That would be wonderful, but we'll have to start somewhere. And this, to our knowledge, is the first paper which looks at the joint trading of stocks and options in the US using the account level data. And as I described the results, you can think for yourself about whether the average biases and the heterogeneity of investors in our data are kind of our concern. Right. So we do validate extensively the data because, well, every time you get a new data, you're always worried. So one way to validate the data is to look at the correlation with the other measures that people use before us. So, for example, the retail stock imbalances in our data set are positively correlated with retail imbalances in stock measures that other people use, such as the change in Robinhood, number of Robinhood users, the BGZZ measure, and controlling for Lee and Reedy imbalances. We find a positive correlation with measures of retail and aggregate measures of retail investors that people used before us, particularly the single leg option flag in Opera. And we looked at some of the shocks to retail trading. For example, then TD Ameritrade introduced zero commission trading. The trading activity by TD Ameritrade investors in our data set increased relative to other brokers in our data. So we do validate the data. I'll skip this validation test. I wanted to show you one validation test, and we do look at those order imbalances with the stock trades in our data versus those other measures. What we find is we find a strong correlation with the change in Robinhood investors in the BGZ measure, whereas the regular Reedy imbalance seems to be insignificant, right? So the first result that I want to show you is on trade concentration. And to set a benchmark, let's look at the top 10 symbols for stock trades. I don't think many of you will be surprised to see that Tesla, AMC, Apple, Nvidia, like all of those, like some of those crazy stocks will be in the list of top 10s. But I think the most important observation is this last bar over here, which shows that 90% of retail trades are outside of those top 10 stocks. So retail trading in the stock market, at least in our data set, doesn't seem to be that concentrated. How about the options market? Here are the top 10 symbols, right? So the number one symbol is SPY, number two symbol is Tesla, number three symbol is S&P index options. So S&P is the most popular underlying for retail option trading in our data set, which was a big surprise for me because I thought like retail investors will trade options on kind of the same stocks that they trade stocks on. But S&P is extremely popular, and the other names are just high price, different high price technology stocks. What was the biggest surprise to me, although it shouldn't be in retrospect, is the concentration. So all other symbols account for only 40% of all trades, and those top 10 account for 60%. And this concentration did increase over time. So by the end of the sample, our sample period, the retail option trading is even more concentrated. So what does it mean? First of all, it's an interesting fact. Second, it just tells us to be cautious about how we do research. So what should be the unit of observation? So we have approximately 3,000 of optionable stocks. So if imagine a paper which will look at median optionable stocks. So a median optionable stock has very little option trading and very little retail trading. So that could present a skewed picture because all the trading really is going on in a handful of symbols. So that's the stylized fact number one. Stylized fact number two comes from different summary statistics. So despite all of this concentrated trading, retail investors in our dataset do explore, they try different underlines, they do try different option underlines, but at the end they settle on a handful of symbols. That's those numbers over here. And then I was really worried that what we are looking at is just some kind of like a play of money. So I signed up for the trade journal just for fun. But what we see, the average trade size for stock trades is around $7,000, $7,000 to $8,000. The average option trade is $2,000. The medians are, of course, expectedly smaller, but these numbers would be, the trade sizes would be in line from what we know we would expect for someone like who trades through TD Ameritrade, and those numbers would be sort of indicative of those investors. So a lot of those accounts that we see probably would be some of the primary accounts that those retail investors use. So the trade size seemed to be reasonable, especially compared to other papers. Option trades. So the second stylized fact will be about, well, if investors trade options, do they buy or do they sell? So whether they enter by buying an option or whether they enter by naked selling options. And 87% of trades in our data set will start with the purchase of the call of the put, and only 13% will be naked sales. This makes a lot of sense. That's because, well, many brokers, for example, Robinhood prohibits naked short selling of options. So you need to have a special permission. Even at other brokers such as IB, you need to have a special permission to naked sell options. Retail option trades will be concentrated in short-term options, and especially a quarter of those trades will be in so-called zero-day to expiration options, the options which expire the same day. The average trade size will be 6 contracts with a median of 1. So some large trades out there. The holding horizon will be very heterogeneous. So the average holding horizon will be a couple of days, but the median holding horizon will be just 30 minutes, right? So this heterogeneity in holding horizon will presumably be important when we estimate the profitability of those trades. So we really see that investors enter the trade, we really see that investors exit the trade, and this will allow us to estimate their profitability precisely. But one fact that really stood out to me is this blue box over here. So the median underlying price for option trades will be $260 something. This is even after we drop the S&P index trades to compute this statistic. So $200. How does it compare to stock trades? So if we look at the summary stats for stock trades, the median stock price will be under $10. So $10 for stock trades, $200 for the option underlying for option trades. So you immediately see a huge difference in the underlying prices. So basically what those blue boxes tell us is that retail investors don't seem to be using stocks and options for the same kind of thing, or at least not on the same underlying. So after documenting the stylized facts, I want to give you some idea about how profitable retail option trades are. So we expect them to lose money just because the option bid-ask spreads are pretty large. So retail, the average bid-ask spread in our data set is roughly 3%. So on a round trip, if investors submit market orders, we will expect them to lose like roughly 3%. So on average, they lose under 1%. So what this table does is every column is a regression, where for every pair in option trade, we observe the percentage return computed as well, dollar gain divided by the option price. And then we will regress it on a bunch of indicator variables, right? So the first column, the intercept-only regression, shows us the average profitability. So on average, retail investors lose 93 basis points, and it's highly statistically significant. So is 93 basis points large or small? I already alluded that it's probably not large compared to all the option bid-ask spreads. It's also not large relative to some of the numbers that prior literature reports. It's a little bit larger than the trading commissions in the options market. So of course, like, well, brokers charge zero commission, but there are exchange fees, and the exchange fees will be around like around 20 basis points one way, or about 40 basis points two way. So those losses will be larger than trading commissions, but much smaller than the bid-ask spread. Overall, we don't see that the retail investors lose like a ton of money per option trades. There is interesting variation in profitability. The most interesting one is that if we split trades into buy trades and short option trades, so short option trades make around 20% per trade. We're trying to understand, so this is an early paper, we're trying to understand why the short sales of options are that profitable, but that's what we see in the data. Zero DTE trades seem to be see more negative returns for zero DTE trades. Index trades see negative returns. Stock option trades seem to break even. A variation across brokers, there is some variation, but it's relatively minor. So we originally were very excited to see a multi-broker data set because, well, there are probably some huge variation across brokers. And there is some variation, but we don't see that much variation across brokers. So overall, the main message of this table is retail investors don't lose that much money in options, at least on average. The nice thing about our data set is we see this account level. So within the same investor, we can see what's going on. So if we look at the trader fixed effects, all of the results pretty much go through. So even within the same investor, retail investors make more money on their short option sales rather than their long position, and they do lose more money on their zero DTE trades. So it doesn't seem to be that this variation in profitability, just some investors are smart and some investors are stupid. Even within the same investor, short option sales make more money than long positions. Right. So why do retail investors lose less than the bid-ask spread? So this is something that we plan to explore in a separate paper, which we are working on, but I just wanted to provide you a little bit of the glimpse into that. So on what I do on this chart, we will take this retail child data set, we will merge this retail child data set with Opera, where it's a very good percentage match. And in Opera, we do observe the effective spreads and conventional quoted spreads, and this is what those the other two bars show you. So they show that the highest half spreads are under 1.5%, so the total spreads will be close to 3%. And what we see in this blue bar, we observe the actual retail trading price, we observe the actual quote midpoint before the trade, and we estimate that the actual trading effective spreads are much smaller, so they will be around 30 to 40 basis points. And digging deeper, it's probably because retail investors in the options space, they don't just simply submit market orders, they do use limit orders a lot. So we're working on the paper which will expand on this point about how retail investors are able to execute within the bid-ask spread. So I see there is a question.
Yeah,
actually a couple of questions.
Sure. I had a question. When you were evaluating the profitability of the retail traders' trades, did you look into whether they were just using single leg trades, or did some of them also use multi-leg trades? So, for example, to kind of create a synthetic position or basically a spread position or something like that in terms of when you're evaluating it.
It's a great question. So if I have time, I'll show you that the so-called complex or multi-leg option trades are relatively rare in our data set relative to what we see other investors do in Opera. And what we did is we excluded those trades and recomputed the profitability results, and the magnitudes didn't change much. So the profitability results are not driven by complex trades. There was another question.
Yes, thank you. Yeah, thank you, Dmitry, for this wonderful work first. And if we can go back one slide, please, when you were evaluating the regression. Yeah, perfect. Do you consider that because part of your analysis were based on the median Would you consider you will still have the same robust results if you used quantile regression?
Interesting idea. We haven't done quantile regression, so we probably should. One tricky thing about evaluating median returns for options is if you hold options until expiration, the distribution should be skewed, but I'll show you in a minute that our distribution is not skewed. We can do quantile regression. That's an interesting idea. We haven't done so. So far, what we did is we Winsorized returns. So if we don't Winsorized returns, the 93 basis point number becomes closer to 0. So they lose less money. So what we do to avoid outliers, which is not exactly the quantile regression, of course, but we do Winzorize the returns both on the left end and on the right end to avoid some of the outliers. But we should do quantile regression. That's a nice idea.
Thank you, Dmitry. Thank you.
All right. If there are no questions, let's move on. So I show you some stylized facts. I show you some profitability results. We're still working to figuring out why some of those trades deviate from the average. The last set of results will be, we'll try to understand trading motives by those investors. And of course, we cannot get in their hand, but we can observe their performance. So the first thing we do is we really kind of look into this very striking difference in the underlying prices for stock and option trades, right? So those are the summary statistics which I showed you. So for stock trades, the underlying price is around less than 10 for a median trade, around 50 for an average trade. But for options, those prices are several times larger. So investors tend to trade options on high price underlyings, presumably because they want to affordably participate in those. How does the stock price compare to other trading characteristics? Maybe stock price is just a proxy for volatility or proxy for like those like max returns or expected positive skewness and so on and so forth. So if we run a horse race between the stock price and other stock characteristics, the stock price wins, is the only one which is significant after we control for those characteristics and different fixed effects. To get a little bit closer at the causal effects here, we will look at the stock splits. So after the stock split, the stock price becomes lower. So if it's really about the stock price, our retail investors in our data set should switch from trading options to trading stocks. And this is what the red box really shows. So they're 10 times more, sorry, not 10 times, 10% more likely to trade stocks versus options after a few stock splits, which we do observe in our sample. So this is on the affordability hypothesis, right? So we see the strong effect on this strong correlation between the underlying stock price and the propensity to trade options versus stocks. On the embedded side, leverage side, and on this positive skewness side, what we will do is we will look at the P&L distribution. So if embedded leverage is important, then option trades will have more extreme P&L distribution, and for leverage, they will have more right skew distribution than stock trades. So let's look at first at leverage. So what we see is indeed that if we take an absolute value of dollar gains for stock trades and option trades, we see that option trades, so option trade indicator is significant. So option trades generate about like $100 to $130 more extreme absolute P&L. So highly statistically significant, but on the other hand, economically, that's not that large because, as you remember, the average stock trade is around $7,000 to $8,000. So what's going on here is that retail option trades are about like 4 to 5 times smaller. So if they put the same money, option trades will give you 7 to 1 leverage, but because they're 5 times smaller, those effects partially offset. So at the end of the day, they get around like 2 to 1 leverage with option trades. So in that sense, we see some evidence of leverage, although it's not as economically significant as I would a priori expect. On the leverage side, and again, I have like 1 or 2 minutes to finish. So what we're trying to do here, we'll look at the distribution of the P&L. And because most of retail option trades are buy trades, let's focus on that subsample and let's look at some of the percentiles. So what we see in 90th percentile for retail option buys is $217. And the 10th percentile for retail option buys will be minus $300. So I would call it pretty symmetric. Some people may call it somewhat negatively skewed. it's not really right skewed. So if we look at dollar P&L, maybe those retail investors want to get positive skewness by buying options. That's not what they're getting. The realized distribution, the realized skewness is close to zero. Part of the reason is because they only hold positions for very short period of time, so they don't hold them until the expiration. And the second reason is because of because they really kind of like take their gains early, but they ride their losses, so they do see a strong disposition effect. Right. Multi-leg trades are rare, especially those kind of types where they combine stock positions and the options positions. So we find that the complex trades where they combine multiple options positions account for at most like 15% of all trades in our data set versus 30% in Opera. I don't have time to talk that much about the subsample results, but they are really important, right? So on average, I showed you the results on average, but there are some worries that the average investor in our data set may not be representative. So we slice the data in many different ways. We can look at the investors who hold the positions for more than 1 day versus less than 1 day. We can look at investors who are less sophisticated based on the smallest trade size versus investors who trade in large size and presumably are more sophisticated. We look at active investors versus less active investors. And what we find is that qualitatively our results go through for all of those subsamples, even though quantitatively the numbers do change a little bit. So those partially alleviate the concerns that what we find here will be totally unrepresentative. But of course, we ideally would like to see more research where people will look at other data sets and we'll see whether to what degree those results change for different other results. So to conclude, what we do here, we bring in a novel account level data set. To our knowledge, we're the first to look at the joint trading of US retail investors in stocks and options in recent period. We document a number of stylized facts. We document some basic results on the profitability, and we find those puzzling effects that the stock price seem to matter a lot, while the embedded leverage matters to the degree and the realized skewness doesn't matter that much. So overall, those are interesting and somewhat surprising stylized facts. Overall, my main takeaway from this paper is that the current literature portrays retail option investors as sort of like has this pretty negative picture about what those people do. While we find they're more of the normal time, they don't do super crazy things. They do normal things. They seem to be careful about their execution. They don't suffer very large losses. They do somewhat sensible things. And we hope to use this data in our other papers. So that's all that I have. Thank you so much for your comments.
Thank you very much, Dmitry. When do you need to go to your class?
Well, I'll take the questions right now. So, and
Okay.
then Vincent will also help, of course. Yes, Jim.
Great work. I really find this really great stuff. Now, how much did the size of the account affect the amount of leverage you see? So are we seeing smaller accounts go to options because they have less money and larger accounts less so? What's the impact?
We looked at everything except leverage in this table. So this will be like this red column here, and we need to add the leverage. We looked at every other results. We haven't looked at leverage. That's a great idea.
Yeah, I was thinking account size. So in other words, are richer people in the journal database behaving differently from the smaller accounts?
So what we see is larger accounts and smaller accounts. Larger accounts suffer less smaller losses than smaller accounts as measured by trade size, and all of the other results go through, but we haven't looked at specifically at leverage here, but we will.
Thank you. Great work.
Ingrid?
Yeah, hi, Dmitry. Very interesting paper. It struck me when you looked at the differences between the usage of options and stocks that you could perhaps use another experiment. You use the stock splits, and you could perhaps use the introduction of fractionals, because fractional trading would alleviate the same friction that you're after when you say that they prefer to use options instead of stocks just because of the stock price. So don't know how the distribution of the introduction of fractional is across your brokers, but that may be a nice addition.
This is an excellent point. That was like our number one explanation for why the stock price should matter. Then we start looking at this, and it turns out that fractional shares are certainly binding for Robinhood investors, but they're not really binding for most investors in our data set. So based on the trade size, if we just do back of the envelope calculation based on the trade size, our investors can establish kind of like the same kind of exposure they do for options. Like if I want to buy NVIDIA, I probably want to buy like 5 or 6 shares of NVIDIA based on the average trade size. So most investors in our data set don't have to resort to fractional shares. And this is why I was also thought that fractional trading is ubiquitous, but most brokers in our data set, they don't allow fractional shares. So for example, TD Ameritrade doesn't have fractional shares to this day. And I was like, is TD Ameritrade stupid? It turns out for most TD Ameritrade investors, fractional shares is not really binding. So one thing we did along those lines, we confirmed that our results, especially on the stock price, they do hold separately for the brokers which support fractional shares in our data set. I think this will be like IB support fractional shares in our data set versus TD does not support for the fractional shares. So in our sense, like we thought, oh, it's obvious, it's fractional shares which will explain the stock price result. And then we start digging and it became a little bit puzzling because probably a little bit of this is fractional shares for the small account, but for an average account in our data set, fractional shares are not particularly binding. Great question.
If you still have time, I was curious. I think one of the tables showed that the same investor on the same day will write options and make money, and then will buy options and lose money. And you said that you have explanations to that you guys are working on.
So it's not
could you
exactly
explain a
the
little bit?
same day. So it will be like day fixed effects across other investors, but it will be the trader fixed effect. No, it's puzzling. It's puzzling why the same investor loses money on long trades and makes money on short option trades. Part of this is a index risk premium, but I think like again, it's puzzling. Part of this is just the asymmetry between those positions. So for the long position, I don't need to cut the losses, so I will wait for the long option until it expires worthless, while for short options, they will cut their losses early. But the short answer is we don't know, right? We tried different explanations, and right now we're looking into some of them, but we document their sterilized facts, and they're super very robust. Finding explanation is a little bit more challenging. I actually will have to go, but I hope that Vincent will help answer some of the remaining questions. Vincent,
And thank you, Dmitry, for being here, and enjoy teaching.
Well, I really appreciate the comments and questions. Thank you so much for your feedback. My teaching starts in 2 minutes.
Folks, so we are going to switch to Vincent as the person who answers our questions. Naji, I think I pressed the button that allows you to unmute yourself. I'm going to do it again to see if it works this time. Okay, great. Folks, I think what we also learned from this experience is that if you unmute yourself and then mute yourself, then I'll have to press that button again. So don't mute yourself until you're done with your question.
Okay.
Najib, go ahead.
Okay. Thanks, Andre. My last question is, why are you considering approaching the problem via fixed effects? It means you are disregarding the possibility of having different sensitivities related to the starting point, at least to the constant. And considering that all variables are independent, actually. So why aren't you considering the mixed level effect models while using quantile at the same time? Thank you.
Thanks for this question. I mean, the reason is that I think we want to keep things simple. And so we are kind of interested in knowing kind of within a trader what's going to happen. I mean, I doubt, given that the results are pretty robust, kind of in the specifications we have tried, I don't think it would really make a difference. But if you have any specific, specification that you think would be interesting for us to implement, we'd be happy to kind of hear about it. But I think that it's kind of a little bit clearer if we keep things simple, and I would not expect the results to change that much given kind of the robustness we've seen across subsamples. Yeah, thank you.
Okay. Oh, Tom.
Yeah. So Vincent, I'm curious if you could say a little bit more about like how people use options for either hedging versus Dmitry talked about leverage. I'm wondering whether you see a class of investors who use options for hedging.
So we look at this kind of complex trades, and so what we find is that the only type of complex trades that we see in the data set that's kind of high fraction is kind of more like spreads, butterfly spreads, and things like that. In terms of hedging, we just don't see much of that in that data set. So it could be, what we cannot rule out would be that they have some other assets in some other accounts that we don't see, and that they would hedge these other assets. So that we cannot rule out. So maybe they have something in there. They have another account where they don't trade at all, and so they would take that into account. So, but in the data set itself, we don't see much evidence of hedging, actually. Yeah.
All right, folks. If there are no more questions, I just wanted to thank Dmitry and Vincent again, and all of you for coming. And we will see you all in 2 weeks for our next installment. See you then.
Thank you, everyone.
Thank you. Bye-bye.